Commercial property investing can be complex, so understanding some of the key terms we use in the industry may be helpful when considering an investment into Australian commercial real estate. So today I'm going to take you through some of the most common terms and explain what they mean. Occupancy refers to the extent that a building is full and whether the building has tenants and how much of the building is leased. It's most commonly measured as a percentage of the occupied floor space to total space in the property, but can also be done as a percentage of the net income in the property versus the total income expected from the property. Commercial property performance benefits greatly from high levels of occupancy. Higher levels of occupancy mean greater income that can be distributed to investors that own the property. A product disclosure statement, or PDS for short, is a document that contains key information about an investment product, including a direct property fund. A PDS provides an overview of the investment as well as outline the benefits as well as risks that should be considered. It will include the costs of the financial product and any other fees associated with it. If you see something as being tax deferred, this refers to the possibility of paying tax in a different financial year to the one in which income is distributed. A triple net lease, referred to as triple net or 3 Ns, is a lease agreement whereby the tenant pays all the expenses of the property, including real estate taxes, building insurance, and repairs and maintenance. These expenses are in addition to the cost of the rent that the tenant pays. It is a great lease structure to have if you're a landlord, and it's something we actively seek out at Charter Hall. The vacancy rate refers to the extent that a property is vacant or how much of the building is not leased. It's the exact opposite of the occupancy rate. A low vacancy rate is good because it means that the property is providing more income that is available to be distributed to the fund's investors. Valuation refers to the value of a property, and it's usually calculated by an independent and registered valuation professional. The valuer will use a combination of discounted cash flow, capitalisation rate, and direct comparison techniques to ultimately arrive at a fair market price. It is the price that is assumed that a willing buyer and willing seller would transact the property at. At Charter Hall, we typically have all our properties independently valued every 6 months or more frequently if required. WALE, or weighted average lease expiry, refers to the average contractual and legally binding lease expiry between 2 or more tenants. A high WALE means tenants on average have committed for longer periods of time in the building or portfolio of properties. The weighting of WALE is calculated based on the amount of floor space a tenant occupies, or the income they're generating, or the relative valuation of the assets in the property portfolio. At Charter Hall, WALE is something we very much focus on. It means we have greater level of income security, meaning we have reliability of the income and ultimately distributions which we pay to our investors. Yield is simply income divided by an investment's value. For investors in property funds, the income yield is often quoted by a manager. It is the value of the annual income distributions paid by the fund divided by the unit price at a point in time. For example, if a fund had a $1.50 unit price and was paying an annual distribution of 9 cents, it would have a distribution yield of 6%, being 9 cents divided by the $1.50. So these are just some of the many pieces of financial jargon you'll come across in relation to commercial property. I really hope that this short video was beneficial to your understanding of the sector, and thank you very much for joining me.